So good morning. I'll try to be your second morning coffee and keep it energizing. First of all, I'm very humbled and honored. Thank you, Nicholas, for including us in this panel as moderator. As brokers, it's great to moderate. Usually we're asked a lot of questions, so today we will ask the questions. So it's refreshing. We have a great panel today. All these people have made a fantastic career in shipping and really a fantastic progression. So I'm sure they will share quite some valuable insight with most of us today. So let me just quickly go through it. So let's start with, of course, Gary Vogel here as CEO of GoodBulk, and then Carlos Pena from CTM, and Edward Buttery from Taylor Maritime, and then, of course, William Fairclough that you all know, and you're all very familiar with, Kwong. So we have a mix of private and stock-listed companies, and we have in the middle an operator who's going to be bombarded in questions more than the owners, I'm sure. So first of all, I will go through a very quick overview of dry bulk. I will keep it very brief. It's going to be 4 minutes max. It's just to put the discussion of today's panel in the context of the market at the moment. I guess I have to use this. So, few words, IFCHOR GALBRAITHS, we have just merged. We're very proud of it. It was a lot of hard work, worked very well. GALBRAITHS is, of course, a very traditional UK shipbroker that has, moved in the years to be very, very competitive. We're very proud of it. And secondly, let me also quickly speak about the team behind us. If I can speak today, it's also thanks to the excellent people that we have. Both in the research team and sustainability. We do invest, we do dedicate our earnings to really groom up people on research and sustainability to guide us. We like to be better informed, otherwise we would be blinded and mute with the clients. So that's, a big thanks goes to them from me. Now, let's go to the core of these few slides. It's, after the disruptions of COVID, it was very, very much a question mark, what would happen next, and the demand keeps on growing. So the demand has been extremely good for the last year and keeps steady at the moment. So all goes well here. Apart on the grains, which for different reasons also linked to the war, the ton mile is actually down a bit. On the other commodities, the ton mile is actually very positive. So, from my perspective, even seeing the activity we do, the volumes are great. We keep on fixing actually higher volumes every year. So that's a good sign. Now, the freight rates are weaker, and this is a 5 years range you see here. And as you can see, 2023 is at the bottom of the range. So, we're wondering why. We have demand, which is very good, and the freight rates, which are not really great. So some of the answers are on this slide. We have two main factors. One is the fleet change, which has, at the moment, the fleet change is not really, a great signal for the market. And the second one is the global congestion. As you may know, during post-pandemic, the disruptions have been huge, and there was, big congestion in every port. And, just as a matter of an example, the Capes on average were staying in China about 12, 14 days, and now they're staying probably between 3 and 4. So this artificial supply has been, missing in the last year and a half, 2 years, and that essentially made the market more supplied and oversupplied at times. For every cargo you put out there, there are vessels offering. At the same time, the flow of fixing is very good. So we don't expect either, going down from here because the flows are very good. So just the last slide, really to recap a little bit, the situation that we've put here some bull flags and some bear flags. Obviously, you see the 4 charts are for the 4 main sizes that are on dry bulk traded every day. So the demand is up year on year, as we said, and there is strategic restocking from China. This is a very interesting element and probably one of the most interesting ones because China is thinking in geopolitical terms rather than merely economic terms. And then at the same time, we got more supply, less congestion, and of course, the doom and gloom feeling that we all feel with this recession, because we have to call it a recession, and whether it's it's going to be a protracted recession or not, that we will see. Now, I'm already done with those slides. It was just to put it in context of today's panel. So I would move on to the first questions for the panel. And we will go through the four of you, if you don't mind, so at least we hear your thoughts on it. So, do you think the dry bulk market will go past the macroeconomic turbulence we're living in and the relative weakness of the Chinese economy? Can we start with William?
Thank you, Manu. At least I get to go first, so then they answer all their questions for them. But I probably won't, given the experience on the board, and I'll probably miss something. But I think in terms of China, it's quite interesting because you look at the numbers, I think you just touched on it there. Iron ore, coal, grain, I think they're all record years, year to date, into China. So there's no problem with the demand. I sort of feel like the sort of mood is towards maybe more of a softer landing generally in terms of economics. And I think there's a default optimism within the market. So we've had quite a rough year to date. It's been a pretty bad summer, but asset prices haven't dropped as much as the freight rate suggested they should have done. And I think just the indications that things are getting slightly better and that the economic situation may be not as bad as people feared, a sort of softer landing, we've already seen that reflect in asset prices going back up. So I sort of sense that people are looking past the next 6, 12, 18 months and focused on the broader supply issue, which I think is much more optimistic. And you look at the 2008 block of ships, and we all remember those days when there were so many bulk carriers ordered between 2006 and 2012, and these were the heady days of a broker, the glory days. And that was 15 years ago, believe it or not. So those ships are suddenly approaching a stage where they can't participate in certain trades. And I think that broader supply issue is sort of underpins this default optimism that I see. And occasionally the market we know has a default sort of pessimism. But at the moment, I think people are willing to look past the current situation, which is pretty clear.
Yeah, thanks. And makes sense. Maybe Edward?
Thanks. Hi. I am totally in agreement with you, Will. This year, disappointed in terms of demand and growth in China. They've been vocal and public about their desire not to just throw money at the problem, which historically they have sometimes done. They're planning for a longer-term, deep-rooted recovery in their economy that isn't reliant on a new development in first, second, third-tier cities. And to plan long-term recoveries in economies like China's, you need to have recoveries in all tier of cities, and that takes a hell of a long time. And they have been investing stimulus money in the economy since the end of Q1 this year, and it takes a long time to filter through the economy. Short term, we're seeing a recovery now in rates. I've been looking at Panamax FFAs this morning, and they're all bidding up a little bit. And that's been the sort of trend across all segments over the last few weeks. Handy-size rates, we were trading at $6,000, $7,000 a day only a month ago. And I'm not going to tell you, because obviously we're outperforming the market. Tell all my shareholders that. But, it's $10,000, $11,000 a day. Pacific's lagging a bit. We expect some seasonal weakness, as always, over Christmas, Chinese New Year, etc. But next year, the outlook is relatively optimistic, and that is reflected in the S&P market. Brokers in the room will know that we sold some Ultramaxes at Grindrod recently, and we were not short of bids. We've sold some older handies. We're definitely not short of bids on those. Rates in the last month have not reflected where prices are, and that shows an underlying positivity in terms of demand growth for next year. We don't need China to boom, because actually there aren't really enough ships over the next few years coming, and demand compounds and always has been growing, really. So 9% of the fleet in handies is over 25 years old, 5% of the ultra fleet Supermax over 25 years old. It doesn't take a lot at this point to see a dramatic rise in rates. Decongestion didn't help, but is slowly coming back a little bit. We've got the Panama Canal So buy Taylor Maritime stock.
Thank you, Edward. Carlos, from your perspective as an operator and tramping a fleet in both basins, where would you say that you have felt a difference with the past? I think the handy Supra have been particularly volatile in the last 3 years, and we had disruptions before with the Supra essentially trading higher than any other asset class, and now gone back to a normal pattern. What can you comment on that?
Well, I think it's on the Handys and Supras, we have a lot of influence on container. You saw the rate on containers were great in 2021, and that definitely have an influence on the rate on the smaller ships. But today, you presented on the slides, the volumes are there. We don't have any difficulties to fix ships. I mean, the rates are just poor. I don't think we have idle days on our fleet. On the Supras, you're saying we run 60 ships. I think we have close to 97, 98% utilization, and that couple of points is just cleaning the ships. So volumes are there. Answering your question, I think the market will improve. We just don't see it today, to be honest. I think there is probably too many ships coming from all those days in 2008, 2009 when we were ordering, and the ships are now 10, 12, 15 years old. And it will take a bit of time. China is doing its job. I mean, they are moving a lot of volumes. We have had difficulties with the war, with the grain trades. But the asset prices, as you said, are holding well. I think that is a positive news. But something will have to happen in the, let's say, 12, 18 months, because if not, those prices are going to come down.
Clear. Well, Gary, you're left with all these elements.
It's all been said. Good morning. I think I'll take off on the point that's been made that we don't really have a demand problem per se, in that we've had demand growth in 21 of the last 23 years, and last year was one of the negative ones, and the other was in the financial crisis. And demand is positive, and we've had a lot of dislocations, and I think the unwinding of congestion is the biggest one this year. But it really always comes down to supply. And what we have now is near record low order book and a rapidly aging fleet. I mean, the mid-size segment, which we exclusively focus in, the average age of the fleet is 11.7 years. The record's 11.8, and that was back in 2009 when the order book was 80% of the on-the-water fleet. It's the first time in my career, which I don't even like to say it, 36 years now in dry bulk, where we've had a strong market over the last few years, and we just haven't seen a supply-side response in massive ordering. So I think, clearly there's been areas around demand which have been, frustrating this year, and we've seen a contraction of certain ton miles and a normalization. But we remain really constructive on the market, because as this rapidly aging fleet, we've had last year in the mid-size segment with 4,000 ships, 8 ships scrapped, just 8 ships, and this year it's more than double already, but it's still nothing. So we just haven't had the scrapping over the last 5 years, and that has to come. I mean, ships over 15 years old, they need to dry dock every 30 months. Another way of saying it is 40% of that fleet over 15 years needs to make that decision whether to dry dock. And as you start, these ships that likely historically would have scrapped at 25, 26 years, which is the historic average, are now at 27 and a half, 30 years and reaching dry dock. I think we're going to see a significant increase in that, and a normalization, if you will, in scrapping coming back.
Thank you, Gary. And I think you guys, the 4 of you, summed it up pretty well. That's also a little bit our feeling. And what we do at IFCHOR GALBRAITHS, the difficulty for research departments is really not to say what has happened, but try to guess the future. And here we go with the second question. What do you think will be the winners and losers of 24 and 25 in terms of segments? Cape, Panamax, Supermax, and Handys, and why? And what ship size would you order today, if at all? And of course, hypothetically. Gary, let's start with Gary.
Well, of course, Supermax, Ultramax. No. No. I mean, I think, the Supermax, Ultramax segment, the mid-size, it's versatile in the sense that we carry both major and minor bulks, and about 2/3 of our demand comes from minor bulks. So there's more of a bend, if you will, to global GDP. whereas the larger sizes, I mean, China's responsible for over 70% of seaborne iron ore, demand. So I think it really, the focus and that volatility on the larger sizes, a lot of it comes from China, both positively and negatively. So I think part of it depends on where your focus is. Clearly, global, GDP has been challenged with fiscal policy, Russia-Ukraine war, and a number of other things. We remain constructive. I think that as we've moved through this year, I think there's more of a general feeling that the soft landing, if you will, moderate recession, and is most probable, which bodes well for the mid-sized segment. But I learned a long time ago trying to predict rates specifically is a fool's mission. It's very, very difficult. I think it's better to pull back and look at whether does demand outstrip supply overall, and position yourself based on that, and that's what we've tried to do as a company.
Yeah, interesting. Edward, maybe you want to add some words to that?
Okay.
We'll put it random. So
yeah, sure.
Catch you by surprise.
So, where are the winners and the losers? What would I order? I'm not going to profess to be a Cape or nuke expert, but there's a lot of people, friends of mine, buying overage Capes at the moment. But they have significantly more zeros on their bank balance than me, and a bit more guts. But you can buy an overage Cape today at not much. Yeah, I mean, the downside is relatively limited if rates come back just a little bit. So, for the big boys, that seems to be an area of interest. There are a few monster orders in the Kamsarmax and Kamsarmax segment from Greece. What would I order today? Nothing. Maybe a Sunseeker and go on holiday, but I can't afford it, and I like shipping too much. So. I mean, we obviously are in touch with yards. You're looking at a really nice Japanese Ultra is still very high 30s. You're looking at delivery N26. And I'm generalizing because obviously a lot of people in this room know yards very well, and they tend to find one or two up their sleeve once in a while. But if you wanted to go and make an order of any significance, you're looking at 27 for anything geared in Japan, 2027. You're looking at 33 delivered for a 42 or a 40, and you're looking at 37 to 39 for an Ultra. And actually in China, prices have come up relatively close to that as well. So at those levels, you buy order a 42 for delivery 2027 today, you pay $33 million. You need rates if you put 50% leverage on that, and if you want any return, you're looking at mid-high teens. And historically speaking, that's a big risk, especially since nobody has a crystal ball. We've only got visibility over deliveries for the next 2 years, 2.5 years, and luckily yards are full, so you can make a relatively well-educated guess on what might happen to the market in the next few years if China doesn't completely fall out of bed, and the US, but I wouldn't order anything right now.
Clear. Carlos?
Well, we just sold many ships, so we are not on the buying mood, let's say. I agree with you. I think we will not be ordering new ships at 38 on Ultras or 40 Kamsarmax or 70 million, 65 million on the Capes. It's quite a challenge. Financing is crazy. Interest rates are so high that for us, cash break-even are very, very high. So going to new buildings at the moment probably is not our cup of tea. Then I share with you that to guess next year rate is always very challenging. I hate it. I don't think which is going to be the best sector, but probably in view of what is happening this year and the supply, I will stick on Supras and maybe Capes. I will not give away the Cape neither, but all in all is very, for us, the values that the ship has at the moment are quite high, so we will not get involved in anything at the moment.
William, can you share a bit more what Kwong is thinking at the moment?
Not
too much, of course.
At the risk of getting lynched, sitting on a panel with 3 mid-sized, Supermax handy-size specialists, owners, I think 3 listed companies. You've got 2, haven't you, listed? Yeah, so 3 listed companies are represented here, all represented by the handy-size and Supermax. I think there's an important point to make that the glory days of recent years, which was driven by COVID and what happened in the container market, are behind us. And I think that was a very important driver, especially for the handies. And that's flipped from being a very big supporting factor to potentially, quite a damaging factor in terms of the demand, as we see this huge order book for container ships that hasn't really delivered yet. I mean, I think it was something like 30% of the total container fleet was ordered during that COVID period. And none of those ships have actually delivered, and we already heard the sort of cautionary tale that freight rates for containers are already very low. So that's going to start to eat in, and it tends to happen on the smaller sizes. It doesn't have to be all doom and gloom, but if anyone trying to benchmark where we are today with, where we've just been, that factor has disappeared. And I think, Ed touched on the larger ships. There are asset players who are seeing just the common or garden Cape size as being a completely neglected size. And, there's actually quite a lot of value there potentially. If you, as we all know, with the big ships, when they go, they sort of really go. And I think, we have a lot of Supermax as well. So I'm not... I'm not negative, unduly negative on the Supermax sector, but I just think I'm wary of that, of that demand driver not being there anymore. And so there is, I think, potentially some value in the larger sizes because they have been neglected. It has become very commoditized. I think the Newcastle Max is controlled by a relatively small number of players, and it's much less opportunity for a sort of traditional ship owner and asset player who wants to sort of operate and try and make something on the margin. It's much more industrialized. So for us, as more of a traditional owner, when we allocate capital, we look for diversification. So it's a little bit different to the people on the other people on the panel. So I think new ships are in hot demand. So we have some new buildings which were ordered during COVID that are available now. The funny thing is that we probably have more demand for ships delivered in 2025, 2026 than ships delivered today. So that points, again, to this slightly optimistic forward view. But there's a lot of demand for the newest ships, the most efficient ships. And so this idea of a two-tier market, which, we've talked about for the last 20 years, but I think that's a very practical thing. I mean, we have a multi-tiered market with all the data that we crunch these days. Then, there's nowhere to hide for ships that are much less efficient than the other ships. And, this week in London International Shipping Week, we talk about the market, but geopolitics and the environment and the environmental and energy transition are two huge parts of, what is being talked about, and those will have an impact on the dry bulk market.
Well, you clearly knew my next question then, because the next question is on marine, as the main source of propulsion, will it be the same, will fuel be the main propulsion system in 10 years' time, 15 years' time, or 20 years' time? I mean, of course, the other panels have touched upon this, so maybe just quickly from a commercial perspective, what is your gut feeling telling you?
Yeah, I mean, my just opinion on it, to just not go over ground that's already been covered, is that there's not enough thought about the impact on cargo. And I think that will happen before we have an impact on our fuel. And if we look at Cape size and Kamsarmax, I think Cape size, it's where nearly 50% is coal, and Kamsarmax, I guess it's maybe about 50% people in this audience will know. I think Supermax is 25%, Gary, something like that is coal, is it?
A little less than 20.
About a little less than 20. I personally believe if you look at the energy transition and you go back to first principles, and I sat on a panel yesterday and we had 4 green hydrogen makers representing most of the green hydrogen that's made in the world today, and 3 of them were not even aware that Maritime had a potential demand for green hydrogen. That tells you everything you need to know, is they have a lot of markets that they will be looking to address before transport, and shipping is a subsector of transport. And I don't want to be negative about the transition. We're doing what we can, and there are many different factors of that, and this is not the panel we're here to just talk about. But by the time that is a realistic alternative on the fuel side, where we're talking about net zero fuels, then there's going to be no coal being moved about if the transition happens in a logical and market-driven way, and I believe it probably will.
Thanks for that. Can you maybe, let's start with Gary, maybe a little bit your view on, on fuel propulsion and what you're doing for it and what you're thinking ahead?
Yeah, I mean, first, just to go back, I mean, conventional fuel can't be the dominant fuel in 20 years if we're going to meet any of these targets. And Knut earlier said, it's definitely a challenge. But as we move forward, as the technology and the fuels become available, we need to move as quickly as possible if we're going to get there. I mean, what we're doing, and I know you've heard this from other owners, right? We're doing everything we can to make our ships as fuel efficient as possible. I mean, we're constantly, trialing new hull coatings. We're using robotic skates to clean. We partnered with a company on using technology and weather buoys that we're helping to put in place off of our ships for better weather routing. And it's a win-win, of course, for the bottom line, fuel saved, but also from an emission standpoint, and whether you're saving emissions today or the future, a ton saved is a ton saved. So it's all of those things. I mean, we are also in the mid-size spot tramp business, so we don't have set routes, and so the fuel supply chain is going to be probably the biggest determinant of when we can order next generation, call it zero emission ships, because we don't, 10 days before our ship finishes discharge, we don't know where we're going to on almost all of our voyages, and called on 400 different ports last year. So I think what's really critical is to have clarity for us that it can be a decision that's based on economics as well, and we believe we'll get there. So our focus is, going back to the last question, what ship would you order? The answer is none. Also partly because we think the tail risk of that is massive. It's about focusing. I mean, we've all the ships we've purchased are focusing on kind of the 3 to 6 year old, right? Highly efficient Ultramaxes. 50 of our 52 ships are scrubber fitted as well. All with a view to be in a position where those ships will be 80% through their economic life in 2035 versus a new building today, which is only going to be a third through its economic life. We just don't think that risk reward is where we want to be. And we think it'll come into clarity will come over the next few years where we can position ourselves, to then look at what we'll order next.
Thanks, Gary. Carlos, just a little bit of insight from you. You're operating actively the ships. Yeah. What do you think about, I guess you're targeting eco ships as well to operate. And what do you think about the future?
I think answering next 20 years, we will not be consuming what we are consuming today. But I think there is a gap between that logistic in ports, as you were saying, mainly on the smaller ships that go to 400, 500 different ports, need to be ready. And that is, let's say, not a job of the owners. It's more the politician behind this one. We will have a gap between now and, 2030, where the conventional engine, very fuel efficiency, and the data will be the new fuel. I mean, information, guidance, artificial intelligence, whatever will improve the performance of the ships, and in parallel will send less emissions to the environment. The view of CTM, and one of the reasons why we also sold the GoodBulk fleet, is there are going to be a couple of different tiers of ships. It will be the old ships that will be consuming. If you compare, for example, a Cape that was built 10 years ago with a new build, and you have almost 30% different in terms of performance, which is a lot of CO2 also. So add to that data information, digitalization, and the shipping industry will collaborate with enough by 2030. Then the next step, going to 2050, then we need something else. And I don't think it's on this panel discussion, to be honest.
Clear. Edward, how do you tackle fuel transition in Taylor Maritime? Do you look at it thoroughly? Do you think about it in the long term? What can you tell us a bit about that?
Thanks. So let's where to start. We focus on the low-hanging fruit in terms of the easy wins and the small gains. Taylor Maritime is not going to change the world when it comes to what we burn and where we stem fuel from. One of the biggest challenges that an industry like the geared sector faces is infrastructure supply. So, and that's, I think we're at least a decade away from even knowing what the long-term solution in terms of fuel is. If you ask yards and other owners, most of them kind of think ammonia probably. But the reality of the matter is handies carry food, and food shortages is something that will destabilize global economic markets far more than what fuel we burn. And my director of ESG has just walked in. He's going to hate me for saying this, But ships actually burn less fuel per ton than anything else in the world, and we have the most efficient way of transporting goods in bulk. Don't print that, please, anyone. So Taylor's not going to reinvent the wheel. We're looking at monitoring emissions, data, paint, everything Gary mentioned, and we're going to leave the industry changes to the boys with the big balance sheets, boys and girls with the big balance sheets. Yeah.
Yeah, thanks. And just a quick comment on your replies, on your answers now. What we see from our perspective as brokers, we see there's been a lot of money in the industry in the last couple of years, right? Made on containers, on tankers, and to that point, nobody really looked at new building. There is a lot of activity on second-hand, and there is a lot of activity on energy-saving devices, and in really doing an effort on the fuel side. And I think we have people who are obviously more proficient than me in that, but the fuel is improving every year of some percentage, and that has to be accounted. So the norm now that we see in the market is investments in energy-saving devices, in weather routing, as you're doing, Gary, and not yet there to really take big steps on new technologies. Now, there is though, 1st of Jan, there is the EU ETS scheme, which is going to kick in. It's a reality. We're also doing a lot of homework internally to make sure that we as brokers are prepared to explain it, to understand it, and to really guide the clients. It is a serious matter. Now, how do you work around it? Do you monitor your emissions already? Are you using third-party systems? Are you using your own systems? What steps have you taken? Because, of course, due to the political framework, this is going to be a necessary thing to apply and to comply with. Can we start with Gary, maybe?
Sure. I mean, of course, we monitor and we report on our emissions. In terms of getting ready for EU ETS, the practical things are opening a trading account and things like that. But I already mentioned, we're effectively a spot player. And so in that regard, our trading to the EU is going to be very much dictated by being paid for the costs that are involved with going to the EU. I mean, it's not dissimilar from the discussion in 2019 when all we talked about were scrubbers and will you get paid for it? And I said the same thing. If we don't get paid for going somewhere or we can't use a scrubber, we won't go there unless we're paid more for more expensive fuel. And it's going to be the same for Europe. I mean, it's simple. If Europe is going to have to pay for this cost, or at least companies like ours that don't have set contracts into the EU will trade elsewhere. And so I think the market will be quite rational in that regard. Now, I think it becomes a bit more difficult and nuanced when you have long-term contracts and you need to go, and then who's going to pay for it. But as a spot player, it's quite an efficient. I think it is an efficient market, and the freight will price accordingly. And of course, our more efficient ships, the newest ships, are going to be able to trade to Europe more effectively because that incremental cost is going to be less. We have so many regulations over the past that come into effect, and often, there's talk about, ships are going to be sitting. I remember the first Ecozone, people said there's going to be, 1,000 ships sitting off waiting for low sulfur fuel, and shipping figures it out pretty quickly. Yeah. And so, I'm sure we'll have some teething, pains and things like that. But I think very quickly it's just going to be another thing in the past that we deal with. I would say, these regulations all, point towards larger organizations becoming more efficient, being able to deal with them. It's just, whatever it is, right? You need scale in order to deal with all these things on an appropriate basis, and I think that's only going to increase as we go forward.
Thanks. Carlos, just a quick question for you. As an operator, I guess sometimes you have to sell freight to avoid charters. Are you thinking about strategies of maybe using also the carbon credits in order to manage your exposure in at least in EU?
Yeah. We are thinking as on. We are prepared already. The discussion is if you can rely on the charters or not all the time. I guess if you go with A1 accounts, you will not have an issue. Maybe with somebody is not Tier 1, let's say, you will have to be on top and try to do it yourself rather than the possible to them. But I agree with Gary as well. This will be quite simple. I think we are just complicating the things. It's not going to be more difficult. You have the efficient ships coming to Europe. Then it will be a Europe problem that maybe will not be so competitive because you are adding a tax and the goods here are going to cost more. we will be paying more for the light. So it is going to be a more, what I hope is we don't start to have different ETSs in America, China, Australia, because then it becomes messy. And if we go to that direction, it's a little bit more complicated. But I think charters are already prepared for it. The people who has their COAs coming to Europe, they are considering that factor. If you are pricing next year cargoes, that is an item like in years back, I remember when I was doing containers, was the bunker adjustment factor. That is more or less the same. So it's not going to be too complicated. Might be, as I said, that specific, more fuel-efficient ships will be in this area rather than in the others.
Edward, what are you doing in terms of emissions? How are you monitoring them? Do you have an internal system already in place? Do you have a third party that you use just to understand how you think about monitoring all that? And
we use a third party monitoring service, and we feel that in the coming years, data collection is going to be critical to the next step in improving emissions. Yeah.
And I guess your ships mostly are out on time charter, so I guess it's more a question of agreeing the clauses that make sure that the tax is taken care of.
There was a point, there were several moments over the last few years where we basically couldn't fix through certain periods of time because there were no agreed clauses. But now we're working well with our long-standing partners. And luckily, a lot of those partners of ours, major shipping companies and trading houses, you have to have a partner who you trust to behave in a certain way. And we're lucky on the handy fleet that we have partners like that. And if we have a clause that it isn't necessarily that clear, I have faith in the CEOs of those companies or the heads of the dry freight departments that we're going to find a way around it that's mutually beneficial. Yeah.
Clear. Thanks for that.
Sure.
William, what's your view there on emissions, quickly, maybe to have your point of view?
I think Gary's right that it creates a premium paying area. But I think the factors that contribute to that, one I would add, is the idea of getting an EU bank account may seem pretty sort of banal sitting here in Europe, but within Asia that's not the case. And that's actually quite a major barrier for some people to, it may be the ship manager that needs the bank account, but you need to open a trading account. You need to have, I mean, we're having to open an EU bank account, and as well, Kwong, we didn't actually have one. We sort of have found one actually, and that is an essential part of the process of registering. And for a huge number of Asian entities, they don't want to be part of the potentially, sort of within the EU taxonomy. So what that means is it's not that there won't be enough ships, but there may be less ships willing to enter into the EU ETS than currently there are now. And that will just contribute to this idea of a premium paying thing. I think we're using a third-party service to monitor emissions, and I think that will probably become a growing industry. I mean, data, there's so many different vendors selling all sorts of different things. You have to pick your way through that, and it's a bit of a maze. But I think the ETS has given a catalyst for a lot of these guys to sell something that actually has quite a lot of value.
Sure, thanks. And as Gary said, I think it's very interesting to say, shipping has always figured it out. And I remember, agreeing clauses 1.5 years ago, where basically the clause was really a gentleman agreement, and essentially the clauses have now evolved to being, more to the point and more binding, because people do partner in shipping, and at the end of the day, that's what we do. Now, we have 1 minute, and it's going to be a very fast reply on, for the future. What will prevail for you as a manager, as a managing director, CEO? Will it be digital or human talent? Just quickly, so at least we have a last snapshot from you.
I think people's always the most important thing.
So human talent here.
Yeah,
Carlos?
people is the main asset.
Same. Absolutely. 100%.
Yeah, I think you need both. I mean, you can't choose. There's a rubbish choice to make.
Well, thanks for that. We're 34 seconds to go, Nicholas. We did a good job, despite my Italian roots. We kept it on time. Thank you very much. The panel has been really great. Thank you for participating.